Well, welcome to the second market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here, joined once again by our esteemed founder and CEO, Bob Paolucci. Bob, welcome back.
Hello, hello.
So we have decided this year that we are going to have a monthly market update. So the goal is to have shorter updates in terms of what's going on with the markets. And already, Bob, we spoke last month about what we thought was going to transpire in 2023 that would be dramatically different than last year. And we're already starting to see that. So we wanted to talk a little bit about how the markets have kicked off this year and follow through with some what we should be paying attention to, which are corporate earnings, interest rates, and this debate over the debt ceiling, if that's fair.
Absolutely. Yeah, and we're hearing more and more about the stuff that we're talking about in the annual forecast last month. Some of it is playing out a little quicker than we anticipated, but it's happening. So let's dive right in.
Yeah, let's dive right in. The markets so far for January we're up almost about 5%, and there's what's known in the industry as this January effect. So we thought we would kick it off here. If you can share with us what we're looking at.
Yeah, it's talked about, maybe not so much on TV, but it's talked about sort of in our industry. January sort of sets the tone for the year. It's quite accurate. When you start with a positive January, start a calendar year, it's positive more often than not. So we always love, behind the scenes when we have a great start to a year. And this year we got it. So for the month, the markets are up about 5% or so. And that is a good start, and that is a good omen for the markets here. So we're happy to see it. And again, it comes after a disappointing December in the markets. There was no Santa Claus rally. Santa brought coal to the markets in December, but so far to start this year, things are looking pretty good.
Yeah, and so I guess just to clarify this January effect, the study has shown that when January is positive, the remainder of the year tends to be very good. In fact, I think it's an average of about 10% for the remainder of the year. Certainly not making any promises, but off to a good start.
That's right. Yeah, and I think it's partially driven by the Fed meeting in December, where the Fed stepped down from their large 3/4 point rate increases down to a 0.5 point increase, sort of setting the tone for another step down in the future. We talked about this last month, that we thought the February meeting, which was just a couple of days ago, the Fed would very likely step down from 50 in December down to 25 in February. That's exactly what they did just a few days ago. But what we found more important, not necessarily the action of stepping down to 1/4, was the tone of the Fed, right? They acknowledged that inflation is falling faster than they thought, and that looking forward, they see maybe another 1/4 point increase, but that's it, right? That's what it sounds like. Jerome Powell, the head of the Fed, was asked a few market-related questions, saying, are you okay with the way the equity markets have reacted to your step down in interest rates? And in prior meetings, whenever you talk about the market, he got very hawkish. He got very negative.
Yes.
This go round, he really didn't address it.
Yeah.
And I think maybe deep down he wants it to start turning. So long story short, I think the market and the market participants and a lot of the economists now and a lot of the forecasters are seeing the end. Something we've talked about for some time now. It's winding down. The Fed will be done soon. And if it's not March, it'll be shortly thereafter. So they'll definitely be done in the first half. Many are saying that they expect March, the Fed, to wrap it up. And, with the wrapping it up, that is a very good thing for the equity market. It's something the bond market had already priced in. I guess that's why they call it the smart money. It's something that we talked about in October, saying that the bond bull market has begun. And I think that is all directionally right so far. So,
yes. And I think just to clarify too, because we have talked about this so much, yesterday was the 7th rate increase. but and the market was expecting it, and it did exactly what we expected. Was instead of raising it 0.5% or 0.75%, which were the last 6, it was 0.25%. Which again, we've been talking about this on these webinars a lot, and the markets were prepared for it.
Absolutely. And I guess the other thing to think about too, don't be afraid of another 0.25 point increase. Rates have gone from 0, the Fed funds rate have gone from 0 to now 4.75%. Another quarter isn't going to break the back of the market, the economy, so on and so forth. It might, if we get there, it might just be the Fed doing what they said they were going to do.
Exactly. So again, the markets are expecting it.
Yeah, it might be the Fed just doing it to remain credible, in essence, right? Sure. But again, the Fed's own forecast and the market forecast, which is up on this chart in front of us here, if you look to the right, the direction of rates is the dotted lines. Correct. And whether you use the Fed's language or you use the market's expected path, rates are...
The Fed's language, is the blue.
Yep.
And the market is the green.
That's correct. Yep, both are coming down pretty quickly and pretty substantially. I do think the question now is, will that path start before the end of the year, or will it start the beginning of next year? Okay. And, right now the forecasters are split sort of 50-50 on rates starting to decline before the end of this year or the beginning of next year. So we shall see. But keep in mind, the reason why we even put this up here and bore you with it is because this is a bull market creator, right? This makes the markets rise. And if they're going to cut rates, in essence, in half, that is going to create an opportunity for equity markets and the bond market as well. So things are going to look really good soon. We all want it to be tomorrow, but it certainly will be soon. And it looks like it'll be this year. So okay. More to come on that.
More to come. If we could talk a little bit more about the markets. We kicked off this webinar saying that the S&P was up about 5% for January. This is giving us a much broader visual of what happened in the left-hand column for the kick of, for the start of 2023. But if we can talk a little bit about what that looks like.
Yeah, this is a busy chart. And again, this is, if you're listening or watching the video, these slides will be attached. It'll be easier to read. But ultimately, these are a list of various asset classes, indices, sectors, commodities, bond market indicators, and countries. Mm-hmm. And really, just to focus on the top left-hand side, you have the S&P 500, which is a listing of the 500 largest publicly traded companies in the United States. For the last 12 months, it's down, approximately 10%, but year to date, it's up a little over 6%. The Dow, which is a very concentrated, heavy industrials, light technology index, is up just only, under 3% in January. But however, the past 12 months, it's down only 1%. The NASDAQ, where all of the big companies live, Apple, Amazon, Google, Facebook, Netflix, up 10% for the year so far, but still down 18% over the last 12 months. So, just a good indication that there's some rally off of, let's call it oversold conditions at this point. And hopefully that momentum continues. So bottom right-hand side, if you want to take a peek at it, is really the bond market, the rarely talked about bond market, but the biggest market in the world. You can see there that 20-year treasuries are still down 23% over the past 12 months. However, they are up about 7% so far this year. So, a good rally in both stocks and bonds to start the year. That makes us happy. I'm sure it'll make our clients happy. You'll see it in your portfolios when your January statements arrive. And we will take a flat market for a couple of months. We hope that we don't give much back, but that's going to be really based on earnings. So,
yeah, and I think it's also interesting to note when you look at this page that some of the harder hit areas last year are the ones that have rallied the most in January. You brought up the 20-year treasuries. You look at the NASDAQ 100, which was down 18%. Now it's up 10.6. So I don't think it's sustainable throughout the rest of the year, but it's nice to see the transition.
Yeah, we've received a good year's worth of return in some sectors and some asset classes in the month of January. So that's a good way to start.
Great way to start. And I
Yeah.
think the next segue, which we have to address, is earnings. We are at the peak here of earnings season. And I know you talked about a few of them already, but if we can talk a little bit further about this.
Yeah, and Julina, so let's again, we keep going back in time here. If we go back to our 2023, outlook, let's call it, what we see in last month's video, we talked about last year being dominated by inflation, supply chain issues, Russia, Ukraine, the midterm election, and the Fed increasing rates by the most ever in the shortest period of time ever. That's all we really talked about and heard on TV. We're projecting that this year you're going to hear obviously less about inflation, seeing that it's ice cold and getting colder month over month. You'll hear less about the Fed increasing rates, more wondering when they're going to cut. And you're going to hear a lot more about something that fundamentally impacts the stock market, and that is corporate earnings. Generally speaking, maybe except for last year, the stock market, which is filled with publicly traded businesses that sell products and services, and they try to make money for their shareholders. These businesses report their earnings, and when you look at companies that are large, they're in the S&P 500. So we always talk about earnings. What it really is earnings on the S&P 500. It's a good indicator for business, right?
Correct.
So far this year, based on the amount of companies that have reported earnings, 69% have reported earnings that are either slightly above or just above Wall Street expectations. 4% have reported earnings in line with expectations, and only 27% have reported below. And that's a pretty good spread, right? Especially when there's so much pessimism out there with all of the talking heads saying how earnings are going to be really weak, really weak, really weak. They haven't been. And the ones that have missed haven't really missed by much. So earnings are coming in okay. And I would tell you that is one of the contributors to a better January and so far an okay February. So the misses have been slight. The beats have been either strong beats or slight beats, but there's beats. And the beat rate, those companies that have, either met or exceeded, are higher than people thought. So if this continues, and this really was going to be, had the setup to be a bad quarter for most companies, it's not looking that way. So last night, it is now Friday, February 3rd. The big three reported, and the big three are Apple, Amazon, and Google. They reported in one night, which, I think they should break it up a little bit. Anyways, they reported, it was kind of mixed. Google missed, Amazon beat, but gave a little weaker forecast, which in essence is really to lower expectations so they can hop over those expectations in the future. And Apple, who was expected to have a really big miss, they missed, but not by much. And many other parts of their business, we all think of them as a iPhone seller and producer, like their services business, cloud business, some other parts of their business actually reported an increase. So it's a resilient business. So I mentioned those companies because they're a big part of the index. They have a lot of earnings. Their earnings contribution to these markets is enormous. And they reported okay numbers. So the market didn't fall apart. And if we go back a couple of days, Facebook, which is now called Meta, they reported really good earnings. And I think part of that, though, is expectations were so low. And the stock had been sold off, 70% or so in the prior 12 months, that they reported a beat and they got rewarded with a 20% gain for the day. So earnings are coming in okay, and I'm spending a little bit of time on earnings because earnings really will be in focus way more than they were last year. The Fed will be talked about less this year, and it's really going to be earnings that take the market higher. The Fed is going to not hold the markets back much this year. It could only be earnings that do it, and so far earnings look okay. However, the lack of trust in the market for corporate earnings simply means that we'll have to wait to see next quarter's earnings to see if there's any real weakness, right? Because the naysayers will say, well, the real slowdown didn't happen until the final quarter of the year into the first quarter of this year. So let's see what consumption looks like and sales and revenue look like, in the second quarter. And I agree, right? I think when you have this market that is that sort of just took it on the chin last year, it wants to be very sure that earnings aren't going to just all of a sudden fall apart. So this goes back to our forecast in January. We think that the first 2 quarters of the year will have some volatility. There's a chance we might test the lows of last year. I think that still might be in play, but if earnings hang in there and actually continue to look as good as they're looking, then maybe retesting that low is out of the equation, and we'll be re-entering that bull market in equities maybe a little sooner.
Which would be fantastic. And I think this is an important topic when we look at the long-term fundamentals of the market return. And also it is interesting to see, on a day like today, as we're recording this, you only have to go back to last year to think about how some of these earnings reports really had a negative effect on the market in the short term, right? And that has not been the case so far this year.
Yeah, well, when everyone's, sensitive to and looking for bad news, there's an overreaction to it.
Sure. We see it over and over again.
More of an overreaction to slightly bad news than there is an overreaction to actually really good news. So, bad news is accepted. Good news is not trusted and needs more confirmation. And that's just the way it is in the stock market. So
it's all relative.
Yeah, absolutely. Absolutely.
Yeah. Okay. No, that's great. Thank you. And you were joking before about all of the topics that were of debate last year. And one of those topics that we didn't talk about, but that we now need to talk about, is this debt ceiling. This has been prominent in the news. We are getting a lot of questions from clients. And so if we could address this as well.
Yes, we're going to do a deeper dive on this topic in the coming months because we think the number of sound bites related to this topic will only rise over the next couple of months. So we might as well do a deep dive to explain to everybody what it is, what it means, how it happens, so on and so forth. So the debt ceiling, in essence, is the credit limit that this country has to spend money on everything. Pet projects, bills that passed from prior administrations, Social Security, everything, government pensions, all their projects. So,
and that's the limit.
There's your limit. There is our credit limit, right? So what we don't actually have in this country is a limit increase tied to the passing of a bill that is allocating funds to it in the future, right? We have bills that pass that are unread every time, right? So on New Year's Eve this past year, there was a 4,000-page bill that was jammed into the hands of Congress, and they had, a day to read 4,000 pages, which in English means nobody read it. Sure. And they vote on these things. It's absolutely ridiculous, but that's how it happens. And there's no increase that you have to vote on in the credit limit of this country to account for the incredible amount of spending that is hidden in the bowels of these bills, right? So you pass a bill and then you start calculating how much it's going to cost. And then you say, you know what, we're going to run out of money if we don't do something. So I think if we all ran our personal finances that way, we would all be bankrupt, right? But that's how our government operates. Mm-hmm. And if you go back a slide, not to scare you, since 1959, they've had to move the debt ceiling or the credit limit 89 times, and 89 times they did. So, but I should also remind you that all 89 times there were threats of the US debt default. There were threats of, well, you're going to have to take credit for not paying the bills of the United States government. So it's a political tool, number one. There isn't a politician or an administration or a party who wants to be known for defaulting the US government. So of course it'll pass. So you're going to hear a lot about hardball, and depending on which television station you watch, one party will be blamed. You change the channel, the other party will be blamed. At the end of the day, both parties are to blame. They both spend way too much of our money. They overspend it, and they never recoup any of the money. They start projects that they don't finish, so on and so forth.
And just to clarify that, Bob, that's what we're showing in the visual here at the bottom, right? Those are, it's showing the parties and it's showing the years that we've had to address it.
Exactly. There are things like the pandemic spending. Obviously, you need to do certain things, but then there are pet projects from the various administrations along the way, and it just costs money over time. So, I think what you have here is an opportunity for a new Congress, right, to look back at what was approved and an opportunity to negotiate a modification of these various things. And that's just the way it works. Exactly. And this time is no different.
89 is a lot.
89 is a lot. Well, you can almost say it happens almost all the time, right?
Yes, thank you for saying that.
So, but every time it happens, it's always a political event, a political stunt, so on and so forth. I would say the betting odds are that when they start the negotiation, they will come to some type of compromise, and they will adjust the credit limit. The only question is by how much, right? What's going to get pulled out, what's going to remain in, so on and so forth. So that's coming. You're going to hear a lot about it. There's going to be a lot of anxiety. That anxiety is meant for you to take it and to vote the way, whoever you're listening to wants you to vote. But just stay cool, stay calm. Everything's going to be okay. And, turn off the TV. So we'll take a deeper dive into this on a separate one-off video. But again, show that picture of the increasing credit limit. That is our national debt. Correct. So at some point, we have to think about how we spend money and where we allocate it to. And we should have long-term strategies. If you're running a large publicly traded company, or you're running your own finances, you're not pivoting your agenda every 2 years, every 4 years, right? You're creating a long-term plan. Our government doesn't do that. Or they don't do it anymore. It's been a very long time. And you can see that our debt has just grown exponentially. So,
and I also see that, there's a lot of things in this business that we can't guarantee, but I can almost guarantee that this conversation will continue in upcoming years as well. It's not going to go away.
Yep. For the rest of our lives, we'll be talking about this.
Okay. That sounds great.
Yep.
Another question, Bob, that we have been getting from clients is the whole conversation around China and the reopening and the effect that it's having. And so was hoping that you could quickly address this.
Yeah, this was more so talked about by those that say inflation will continue to rise.
Correct.
Because they need something to talk about. So China was locked down, then they weren't. They were locked down, then they weren't. They were locked down. Now they're just going to deal with it, right? Mm-hmm. So they're reopening. And what does that mean? Well, that means they're going to start consuming stuff. And there's been this one-way view where, China coming back online is going to be very inflationary. My argument is China coming back online as an export-based economy is not going to be as inflationary as you think, if it's inflationary at all. And we did a little digging, and you look at where China gets their imports from, right? So when you look at consumption, well, Taiwan, the United States, Japan, Malaysia, Australia, South Korea. So it's a very diverse group. They're not relying on just one country for their stuff that they consume. They're relying on everyone.
Exactly.
And then on the next slide, it's not just one thing. New technology, it's mechanical and electrical parts, it's crude, it's ag products, it's fuels and related materials, circuits, iron ore, copper, coal, all sorts of stuff, right? So it's a very diverse group of consumed goods that China imports.
Mhm.
However, it's an export-based economy. So if this export-based economy reopens, we'll all be able to get the stuff that we're waiting for, that companies are still waiting for, that has yet to be shipped or produced, right? You won't hear about their supply chain issues going forward. There will be no delays. If there are no delays, there's no one willing to pay a premium. If there's no one willing to pay a premium, well, that's not really inflationary, right? That's disinflation or deflationary.
Mhm.
So I don't want to say it's going to be a non-issue, but it won't be as big of an issue because their exporting of stuff more efficiently and effectively will provide some offset to the consumption that they have, if that makes sense.
Correct.
Yeah.
So,
So I wouldn't look too much into it. I guess the other thing with China is now they have a new friend in Russia where they can consume more energy from.
correct.
So
Yeah.
that
So it
so
sounds like this inflation debate around China reopening, you're just not there.
well, I mean, we'll see. But if you really do the math, I mean, if you pay attention to economics or what's going on in the world, you'll know that China is an export-based economy.
Exactly.
The United States and Europe, we are a consumption-based economy. So, us coming back online is inflationary.
Is
We
very
consume
different than
everything
them.
from everywhere, right?
Exactly. Yeah.
China coming back online, they send us everything and they send it everywhere. So I think there's an offset there. So
Exactly.
I wouldn't overreact to that.
Okay. No, thank you for clarifying that. And I think one last topic that's coming up a lot based on the performance of the markets last year in all asset classes is commodities. And I think this always comes up when the markets have such a negative performance like we saw last year. So if you can maybe talk a little bit about commodities.
Yeah, this is our own chart here that we put together with the assistance of some searching our platforms. And what we show here is the spot price of natural gas, right? And if you were quoting natural gas 4 or 5 months ago, the price was probably triple of what it is today. So, what you have a lot of these big firms talking about investing in commodities, buying this commodity, buying that commodity. I learned very early on in my career that if you want to make money, stay out of the commodities market. Right. The commodities market is for speculators and hedgers. So traders that move in and out of spot prices and or big companies that hedge the price of the commodity that they do business in. And that's really who it's for ultimately. So if you think investing in the stock market can get wild at times and you can't tolerate 10 to 20% swings, you should stay clear of the commodities market. This is just a chart of natural gas. And you can see, in 5 and 10-year increments, how incredibly volatile the spot price of natural gas is for any commodity. You have these 80, 90, 75, 72, 74% price swings that are played out over very, very short amounts of time.
Right.
People will talk about commodity super cycles. They talk about having exposure. Exposure to commodities, it's probably the worst risk-adjusted return of an asset class that you can find. A tremendous amount of risk at all times, more than you think. And sometimes there are good returns, but don't blink because those good returns turn into awful returns pretty quickly. So, this is why we tend to stay away from commodities. If anything, when it comes to commodity investing, we will invest in companies that rely on these commodities and are more price sensitive. But relying on those publicly traded companies means there's a buffer. You're not taking the same amount of risk. So we just want to mention this because there's been a lot of talk about commodities. We just want to illustrate to you how wild of a ride it is. And it's not for the faint of heart. And it's really not for most individual investors.
Yeah, and I think people always want to pay attention when it goes up. Look at that price drop all the way on the right-hand side, down 74%. That wasn't talked about the same way. And I think your comment of commodities being the worst risk-adjusted asset class, I would take it one step further and say, I think it's the worst risk-adjusted asset class in the last 20 years. So it may look great in a very short period of time, but this is quite the roller coaster. This is very different than the stock market. So
Agreed.
yeah. So thank you for going through all that. And I guess the conclusion here that we can say is that our view really hasn't changed since we talked a month ago. It's, if anything, we're starting to see what we've discussed play out.
Yep.
And we will certainly be back next month with another update and to continue the discussion. And who knows, we may still be talking about the debt ceiling, and there may be something new on the horizon. So
yeah, we will be talking about the debt ceiling more and more, probably for the next 6 months. I'll just be honest. And then, you know, we'll have another Fed meeting in March that we'll be talking about. We'll see how the market handles a very good January for the month of February, with decent earnings, a Fed that is changing their tune. These are things that are good for the markets. We'll see if it remains at the same level here. So keep in mind, we'll probably tell you this come tax time, but in April, the stock market usually gets sold a little bit for the sheer fact of taxes have to be paid.
Correct.
So another fun statistic for you. So there'll be more. We'll cover many topics. I look forward to chatting next month.
That's great. Bob, as always, we appreciate it. And, you know, we're here for you. If you have any questions, please reach out to us, and we'll be back next month.
Great. Thanks, Julina.